Hello, I'm Susan Nash, AAPG, and Paul Anthony Thomas is here today to talk to you about his pitch at UPitch. Welcome.
Thank you, Susan. I appreciate you being here today, and thanks for your time. Today, we're here to talk about our Ledger Energy Opportunities Partnership. It's a new offering we've put on the street since the COVID debacle has started and since the price of oil has gone down to negative numbers, which is a really freak kind of a thing, something no one expected. But we're going to talk about our Ledger Energy Opportunities Partnership. And as we go through this, you'll see that opportunities in the energy business are really real true opportunities are few and far between. But when prices go down, opportunities really start coming out to the surface fast and furious. So we're actually in the business in this partnership of buying from distressed sellers. And today, if anybody knows anything about the energy markets, you know there are a lot of distress in the marketplace, and we'll see kind of how that comes to fruition. We try to give relief to people when prices go down and people are in debt. They need cash and they need it today. So our operation tries to do research. We've done our research up front, and we try to make quick closings and go in and buy assets for anywhere from 10 cents to 25 cents on the dollar. And we're not trying to take advantage of anybody. We're actually trying to give them relief, and we're trying to get their banks satisfied. And they've been their equity's been wiped out, and then they really don't have much of a chance of getting that back in the next couple of years. And their bank's calling them on the phone every day saying, you know, we need our cash, and they're just in a desperate situation, and we're trying to help them out with that. We buy hardware. This fund's going to buy hardware. We're going to actually buy oil and gas production. We're going to buy real estate if we can find the right deals on real estate. And there are a lot of times when we don't buy stuff for 25 cents on the dollar. We'll actually pay 50 cents on the dollar. We'll pay off somebody's note and just take over their equity position and really good assets, and try to give them some relief along the way. So this chart shows what this is a historical price chart over the last since 1950, and shows the price declines back in the 86 time frame when the oil went from 70 to 25, and then in the 2008 it went from 75 to 54, and then in 14 and 15, actually August of 15, June to August of 15, it went from about $100 a barrel down to about $40 a barrel. So that's kind of a recession like we're looking at today. And that recession lasted longer actually than this one has. But we'll see in a minute that the actual opportunities to buy assets didn't come along until 2015, 2016. So this is a slow moving operation. It's not something where the price goes down and these operators have to sell tomorrow. That's not the way it works. But when you bought assets based on $75 oil or $70 oil and the price stays down at $40 for 2 years, there comes a time in that price range in that arena where your savings get demolished, and you have no more savings, you have no more cash to work with, and you need a partner to come in and help you. And that's what we do. This shows from 2016, the second quarter of 2016, the total debt amount of debt in the oil field. It's been growing astronomically. As young people enter the debt market, they don't really have a feel for what history looks like in the oil and gas world, and they're willing to issue debt when they really shouldn't be issuing debt. And so we've seen the debt burden on the oil and gas business grow, and we're going to see oil patch bankruptcies come fast and furious over the next 2 years. So here's an example. This is Hazen Boone's Oil Patch Bankruptcy Monitor. They monitor bankruptcies, and this shows bankruptcies from January of 2020 to May of 2020. And we've had, what the interesting part, the interesting fact on this chart is that prices in 2014 started to decline in September, June through September of 2014. But we didn't see the actual bankruptcy start up real big until 2015, and they really peaked in 2016. So it took us 18 months to actually get to the point where people's oil companies' savings were demolished, and they needed cash to stave off bankruptcies, or even to help them through the bankruptcies. And that's what this fund is getting ready for. It's a small fund, $25 million offering, but we feel like over the next 2 years, we should be able to place about probably anywhere from 75 to $100 million in this arena. So we're going to talk about this. So this is a chart that shows in 2020, this is the auctions that happened in 2014. And today we would have bought these assets. They sold for $4 million and they had $340,000 of monthly income. But this chart is basically to show our partners or potential partners that out of all these pieces of the property we could have bought, we would have only bought the ones in yellow. So we would have bought 5 out of 20, maybe. So those are the ones we would have targeted. And we would have tried to buy those at a 25% return on our money. That's oil and gas production. In the equipment business, it's different. The marketplace is different because there's a lot more oil and gas equipment on the market than there is oil and gas production. So we'll talk about that. Here's an example of a July 15th, 2015 sale result. Average revenue for the month, and this is 9 months into the decline of oil prices. Average revenue was $35,000, and that property sold for $1.5 million, which is about a 42-month payout. So that's about a 30% return on your money, 35% return on your money. Here's another one. So property sold for $300,000. Averaged 6-month cash flow was $30,000 a month. So that property sold. And this is after. Now this is in September of 15. This is a year after the price decline. So this is an example of the opportunities that we know we're going to see in the next 12 months. So that's why we're raising this capital today. So in our arena, we diversify by location and we diversify by pay horizon whenever we buy production. On this map, the dark states is actually where we own production and where we bought production over the last number of years. And the diamonds are where we would like to own production and like to buy hard assets, oil and gas equipment and things such as that. Natural gas is something, liquids is something we love to buy, oil and gas. And we also diversify whenever we buy production, we diversify by operator. None of our production is under the same operator in any one state, any one field, any one basin. So here's an example of some distressed sellers. In January of 15, this was 6 months after the price decline in 2014 started. Eagle Ford Shale, 1,200 barrel a day, 10,000 acre lease block. They turned down $800 million in June of 14. They asked us to make them a bid around $400 million in October of 15. That was a year later, over a year later. And they wound up selling that asset for less than $100 million in December of 15. So that's an example of how oil operators, they run out of their savings, they run out of their oil and gas production revenues, don't cover expenses, and over a year's period of time, their savings are all going to be eaten up, and they're going to have production that they have to sell. So we had a January 2015 incident where a bank called a note on a natural gas producer who was profitable at $1 a thousand. So what happens in this marketplace is these operators have legacy reserves and legacy income that when the prices start going up, they leverage that income. And then when the prices go down, that income is leveraged, and they have to sell that income, the things that make money, the things that have value, they have to sell that to cover their bank notes. And we're hoping to step in and actually offer them some relief. And we're not interested in stealing their assets. We're just interested in helping them get out of debt, helping them, keep themselves afloat, helping them, being a good partner for them. And we've been in the oil and gas business for well over 40 years, and we understand what a good partner is and what a bad partner is. And we're not here to take advantage of anybody. We're just here to help people get relief. In 1986, we buy tubulars. In 1986, I stood in auction yards in Odessa, Texas and Midland, Texas, and bought oil and gas tubulars for 40 cents a foot at the auction. Well, today we have stuff selling at 40 cents a foot as well that was selling for $4 a foot in January. So, and this is going to continue for the next 18 months. And, our program is to buy these assets, inventory them for a couple of years, and then turn around and sell them when the prices come back. Well, this environment, prices have actually come back stronger than they have in the past. But oil and gas operators, as we saw earlier, are in a tremendous amount of debt, and they're not going to have any relief until oil gets above $50 a barrel and stays there. Well, we don't see that happening for the next 18 months. So we're going to be hopefully ready with some cash and be able to move in and partner with some of these people and offer them some relief. In January of 2015, we could have bought rods, oil and gas rods, 3/4 inch, 1 inch rods for 10 cents a foot that a year earlier, 6 months earlier, we're selling for $1.10 a foot. We could have bought truckloads of them out of Illinois. We could have bought them out of East Texas. Those are an example of just general serviceable things in the oil and gas business. We're not going to jump off and buy some kind of frac rig that has a special operation or special need. We're going to buy oil field tubulars, 2 3/8, 2 7/8, 4.5, 5.5 rods of different sizes, and we're going to buy those and try to help people just when they need cash, just be ready with cash. We find this situation in the same boat with equipment, oil and gas equipment. As I said earlier, we're not going to buy really specialized pieces of equipment. We're going to buy a skid steer that can be used in any environment that we can sell in West Virginia or we can sell it in California. We're not going to get stuck with a bunch of equipment that we can't sell unless we're buying it for scrap prices at the auction. We would do that. So we see tremendous opportunities in the real estate world. We have there places in the oil and gas fields. There's a lot of this going on in the Bakken right now where you can go in and buy yards at auction for really low rates. And you can buy the notes from the bank, and they're happy to sell you a note for 30 cents on the dollar when they know they'd get 20 cents on the dollar if you went to auction. Auctions are coming fast and furious now. In December and January of 2019-20, the auctions were one every month or 6 weeks, and now they're, as you can see here, they're one every probably 2 or 3 a month now. And this is the type of inventories they're selling. We're not in the auto dealer business, so we wouldn't be buying pickups and things like that, but we would be buying 18-wheel rigs and tractors and trailers and things that have other uses outside the oil field. Here's our principals. I'm one of the principals, and my partner's an MBA. He's an accountant, and I'm the geologist and equipment guy. So I'm the science side of the thing, and he's the finance side of our little team. In '86, we saw Resolution Trust Corporation come to fruition and sell things for pennies on the dollar. In '97, we saw banks do it. In 2009, we saw banks do it for sure. And 2014, we saw a lot of assets sell for 10 cents on the dollar. A lot of wealth is generated whenever you have cash and you can actually deploy it during a downturn. So these are the kind of things we're looking to buy. And we also see, as I said earlier, we see tubulars today selling for 10 cents on the dollar at auction. So the only thing you have to take advantage of this is you have to do your research up front, and you have to have some cash to invest. So one of the risk management tools, several of the risk management tools that we use no debt in our funds. Our funds, we pay cash for everything we do. That way we don't have to worry about a bank coming in and calling our notes. We have very limited exposure to drilling. We'll buy production and buy production interests, buy non-operated and operated interests, and we'll operate those interests if we need to. Been in the oil and gas operations business since the early 1980s. We do regular and routine portfolio evaluations. So at any one time, any investor can call us up and say, what's our portfolio worth today? And we can give them an estimated value. And then we continually high grade our products. So we'll continually replace the older products, and products we've had for a while, we'll replace them with newer products. This is a $25 million Texas limited partnership or management fees, or it's a 220 fund. Distributions we're targeting out are 12%. We think that we can probably triple somebody's money, double to triple somebody's money in a 3 to 5 year horizon. And that's what the horizon of this would be. Our minimum investment we're asking on this is $500,000, $500,000 minimum investment. So we're trying to find 20 partners that want to go in business with us and take advantage of this market. So you can reach me at customprivateequity.com, and I appreciate your time today, Susan. Thanks.
Great, thank you.